Today's market environment is defined by an unusual combination of optimism and anxiety. On one hand, investors are preparing for critical U.S. macroeconomic data, particularly non-farm payrolls and the upcoming CPI release, which could materially shift expectations for inflation and Federal Reserve policy. On the other hand, the market is displaying highly reactive behavior, with sharp intraday swings and outsized moves in major tech names, suggesting that confidence in the economic outlook is fragile. What's most interesting is the divergence appearing across major institutional investors. Some funds are pulling back sharply from tech, while others are redistributing, not retreating, implying a more measured recalibration rather than a broad risk-off cycle. And Berkshire Hathaway's latest 13F filing adds another layer to the story, trimming concentrated positions while selectively adding new ones, a move that the market rarely sees from Buffett unless the environment is shifting. At the same time, the tech sector is wrestling with mixed signals. AI demand remains extremely strong, with continued investment across cloud infrastructure and enterprise adoption. Yet the recent pullback feels driven more by emotion, concerns about valuation, regulatory pressure, geopolitical risk, than by any slowdown in fundamentals. So the question becomes, what phase of the cycle are we actually in? Is this the beginning of a genuine rotation away from mega-cap tech leadership, or simply a moment of turbulence amplified by headline fear? And how should investors interpret the actions of giants like Bridgewater and Berkshire in a market that's being reshaped day by day by the accelerating force of AI? With that framing, let's walk through each major development and what it means for the road ahead. We start with the overall market backdrop, which has been defined by pronounced intraday volatility. Global markets are swinging sharply as investors brace for two major macro events, the U.S. non-farm payrolls report and the October CPI data. These releases have become key sentiment anchors because they directly influence expectations for inflation and the Federal Reserve's next rate decisions. Institutions are responding by cutting exposure across equities, not because fundamentals have deteriorated overnight, but because visibility is extremely limited. Inflation appears sticky, and the Fed's messaging has remained deliberately non-committal. As a result, the market is stuck trying to price multiple potential scenarios at once. This kind of volatility signals something deeper. The market is struggling to determine whether we're entering the next stage of the economic cycle or simply experiencing temporary turbulence driven by data timing. Until clarity emerges, sharp swings are likely to continue. We're more than advisors. We're your partners in transformation, guiding you through every step to achieve your highest potential. What's striking in this environment is how differently major funds are positioning themselves. In recent weeks, we've seen dramatic divergences. Some hedge funds are cutting tech exposure aggressively, including notable reductions from Bridgewater. This suggests heightened caution about valuation risk and potential macro shocks. But this isn't a universal retreat. Other firms are reallocating, not exiting, shifting capital into areas with better near-term stability or more favorable risk-reward. This divergence reflects deep uncertainty in the market. Conviction levels are mixed, and no single narrative is dominant. Whenever large institutional players begin diverging meaningfully in strategy, it signals a market that is searching for direction, one where the next big catalyst could reshape risk sentiment very quickly. Now, Berkshire Hathaway's latest 13F filing deserves special attention because Buffett rarely makes sudden or dramatic shifts. This quarter, Berkshire trimmed positions in mega-cap tech while increasing holdings in more defensive, cash flow-driven sectors. This raises the question, are we seeing the early stages of a rotation away from heavily concentrated tech exposure? Or is Berkshire simply managing portfolio concentration after years of strong tech outperformance? Market reaction suggests many investors view this as a caution flag, especially given that Berkshire tends to be early in identifying turning points in overheated sectors. Even if the move is tactical rather than directional, it adds to the sense that the market may be approaching an inflection point. Despite the recent pullback in tech, the core fundamentals of the sector remain strong. Analysts across Wall Street consistently characterize the sell-off as sentiment-driven rather than structural factors like geopolitical tension, regulatory pressure, and speculative concerns about an AI bubble are fueling fear, but actual earnings and forward guidance from major tech firms remain solid. AI demand continues to accelerate, particularly in cloud services, infrastructure build-out, and enterprise adoption. We're seeing strong order books and long-term commitments from both private and public sector clients. So the divide here is clear. Short-term fear is colliding with long-term conviction. For investors, the key challenge is distinguishing between noise and genuine trend changes. This brings us to the central questions investors face right now. First, is this truly the beginning of a major rotation in market leadership? Some early signals point in that direction, especially Berkshire's moves and hedge fund de-risking. But it's equally possible that this turbulence is simply a reaction to upcoming macro data. Second, how should we interpret the actions of major players like Bridgewater and Buffett? Are they positioning for a downturn or simply rebalancing after strong performance in certain sectors? And finally, we have AI, still the most powerful secular force in markets today. With AI investment accelerating at record pace, the coming months will be critical in determining whether tech regains market leadership or gives way to a broader, more diversified rally. Ultimately, the next chapter will likely be written by macro data, corporate earnings, and the continued pace of AI adoption.